These events are the end of free market capitalism. I don't know where people have been living, but where I've been living, we have not had free market capitalism in our history. It's a utopia. And we see what happens when people have these noble ideas of a utopia, the sacrifices they're willing to make in the name of utopia, creating a new man, a new person. These things don't work. And I think that we've never had free market capitalism. Going back to property, the Homestead Act around the time of the Civil War gave people land from the government, gave railroads land. That's how we developed. I think on Wall Street, and I think on Main Street, we have this idea there's a government and the markets as if they're two separate entities and at war with each other. I just don't think it's true. I think we've got to change our mindset to be able to deal with these current problems. I do think that these problems have not only economic, but I think this is why people like Adam Smith, Marshall, the original sort of thinkers about capitalism, they didn't think they were economists. They thought they were doing was political economy. I think it helps us, to stop these fake divisions about politics and economics, state and the market. That it's not, look, we have a revolving door, right? Think about what's happened. In our commentary at Brown Brothers, I was pointing out that Secretary Treasury Paulson was reluctant to take that job in the Treasury Department. And now what he's doing, in effect, as part of the bailout, is turning the Treasury Department into Goldman Sachs, into a place who's going to be buying distressed assets, a vulture fund. And I'm in favor of it. I think we need to do this. We've been arguing that we need to do this 6 months ago. But I think that we got to break our. I think that many times we are our own worst enemies, and we've got to break out. I think our mindset, our ideological mindset, is preventing more bold thinking outside the box. And we're only now beginning to get it because people's back are against the wall, and we're sort of looking into the face of the abyss. So with that, let me just turn it over. Sorry?
Well, Bob, what a great introduction for you for Goldman Sachs.
Thank you very much. Thank you very much. Let me try to also attempt to put this into some historical context, which I think makes a lot of sense. There's a good way of looking at this. And I would go back to several events that occurred around 10 years ago, and you can see the roots of the current crisis in those developments, one of which is the fact that for most of the 1980s and the early part of the 1990s, most of the 1990s in fact, the U.S. had a lot of, the world had a lot of spare capacity in energy and raw materials and a variety of other things. Around the turn of the decade, around the turn of the century, the world ran out of spare energy capacity. The supplies were simply not there. The capacity simply wasn't there to meet the growing demand. And as a result, oil prices and, more importantly, capital flows to the oil producers increased quite dramatically. And a large portion of those, because they have very high savings rate, they haven't consumed all that money. A lot of that was put into the international capital markets, which helped to enhance liquidity in the United States in particular, which was the repository of a lot of that money. The second thing was the Asian financial crisis of 1997, 1998 ended, and the Asians decided that they were no longer going to be in a weak position. So they made a major effort to boost their reserves, their foreign exchange reserves. Instead of having overvalued currencies, many of them thought that the best course was undervalued currencies. In general, they became very focused on strengthening their financial capability, increasing their savings, and certainly increasing their foreign exchange reserves. Those two came largely into the American market. And the third was the bursting of the dot-com bubble, which took place a little bit later. But after that, the Federal Reserve, and particularly after 9/11, the Federal Reserve created a very substantial amount of liquidity. And when the economy started growing in 2003, 2004, it didn't retract that liquidity as quickly as perhaps it should have been, with the benefit of hindsight, although not a lot of people, some were arguing that at the time, but certainly with the benefit of hindsight, they could have retracted some of that liquidity a little bit earlier. But when you add these measures up, all three of these developments, you had a lot of available liquidity, and that liquidity tended to fuel, to a large degree, the American capital market, and tended to keep interest rates relatively low, which fed into the kind of situation that we saw, particularly with the housing market. Housing market was a great beneficiary of this very substantial amount of liquidity that was available for mortgages or mortgage-backed securities or other kinds of securities as well. The broader point here is that we've had this very large global imbalance. We've had American consumers who have been consuming at a very rapid rate. Consumption is about 70% of American GDP up until recently. And we have a very low savings rate in this country, particularly low household savings rate, but also the government is a large dissaver and is becoming more so, as we see in the paper every day. So if you have low savings rates in a country, and you need capital, you get it from countries that have high savings rates, and those are the oil producers, countries like Russia, countries in the Middle East and the Far East that have very high savings rate. So you have this very large imbalance with the U.S. economy borrowing very heavily from the rest of the world lending substantially to the United States. Now, what's happening, I think, is very interesting. You're really seeing a rebalancing. Henry Kaufman made this point. He used this word in a different context, but I think it is an operative word here. What is going to happen as a result of the deleveraging of the United States, the fact that it cannot continue to borrow, particularly American households can't continue to borrow as they were during the early part of this decade. You're going to also see a decline in consumption. Consumption in the United States is going to have to be lower, almost certainly, over the next several years than what it has been over the course of the last 5 or 6 years. You can't borrow against the value of your home anymore, as people were doing, to the tune of about $1 trillion between the middle part of 2005 and the middle part of 2006. You can't borrow as much against your credit card because credit cards are not going to be as generous in making loans, and they're very expensive anyway. And bank credit conditions are going to tighten. So consumption in this country is going to have to come down. The plus is that this crisis, or at least if there's a silver lining to an otherwise very difficult environment, it is that other countries around the world are in a much stronger position than they would have been had this crisis taken place earlier. China, while the point was made that China's growth is slowing, the Chinese authorities have also very recently taken very bold measures to try to strengthen growth. They're not as worried about inflation anymore. They've eased up on credit. They've lowered interest rates. The Russian government has taken bold measures to try to stabilize its financial system. And I think that while growth in some of these bigger BRIC economies and some other emerging economies is not going to be as robust, it is still going to be positive and considerably greater than that in the United States. So the rebalancing could occur if this process works smoothly, with Americans consuming less and saving more, and some of the big emerging economies doing the opposite, saving less and spending more. So it's part of a sort of a global rebalancing. Now, this is the optimum scenario. It's not necessarily going to work out this way for certain. Predicting these kinds of things is very hazardous duty. But I do think that's one of the things we're now seeing happen in the global economy. A country that had huge current account imbalances, which is the United States, huge trade deficits, the United States again, and a very low savings rate, will have to save more. The current account imbalance is already narrowing. The trade imbalance is already narrowing, which means we won't need quite as much capital. The question is, will other countries who've relied very heavily on the American economy juice up their domestic demand, their domestic investment, and enable this rebalancing to take place smoothly? If that happens, it's still true that we're going to have a period of very slow growth in this country because American consumers don't have very much in the way of savings to fall back on. But some, not all, but certainly some of the weakening of the American consumer can be mitigated by stronger growth than otherwise would have occurred in some of these emerging economies. So I think that's one of the shifts that we're seeing in the global economy, and perhaps over the next several years that shift will continue if we can deal with our own problems in a smooth fashion, and if other countries can sustain and strengthen domestic demand and not rely as much on exports to the United States or Western Europe, for that matter.
Good. Bill?
Okay, well, thanks for having me, and I'll summarize a speech I gave actually last Friday. I was in Paris to addressing a large investment firm's client base, and the subject of my talk was an American perspective, both on economics and politics. And I was reminded initially of something the great economist Milton Friedman had said. The enemy of socialism is socialism, and the enemy of capitalism is capitalists. And in a sense, we have seen capitalism taken to an extreme, and it is being manifested in the pages we see today. I'd like to step back a little bit and talk about what I think of our two financial storms that we have been dealing with. One is an economic storm, and one is in the financial economy. The financial economy and the real economy are two sides of the same coin. What happens in one affects the other side. But for a little perspective, let's just take a look at globalization. It has arguably been the single greatest positive event that we've had since the end of World War II. In 1988-89, the value of goods and services that were exported, in other words, global exports to global GDP, was around 18 or 19%. Now, I pick 89 because that's the fall of the wall and the death of the isms as I think about it, although some may be coming back now. But in terms of other isms that affected the allocation of scarce resources, which is what economics is all about, socialism, communism, fascism, they all kind of went away. We had capitalism to a greater or lesser extent. That beginning in 89, turbocharged by the growth of the internet, today we have 1/3 of all goods and services in the world are traded. In other words, global exports divided by global GDP is roughly 32 or 33%. That's a fantastic number, and if you think of it in terms of the absolute increment of real volume, it's phenomenal. And it has been good for every single nation who participated in it. Real growth has been better than expected, productivity has been better than expected, inflation has been less than what you might have expected given all that growth. Essentially what happened was the greatest shift in history between capital and labor. Roughly 3 billion people joined the world as we know it with the fall of the wall, particularly the entry in 91 of China to the WTO. But importantly, these 3 billion people brought no money. They brought lots of man hours, but no money. So what's happened for 20 years is this enormous labor arbitrage. And it's actually worked for everyone. And the reason for that, and I won't take the time to elaborate it today, was the law of comparative advantage. David Ricardo's law that was developed back in 1820 is arguably the most powerful law in economics. Essentially, it says nations should specialize in producing the goods and services where they have a competitive advantage, take the excess of that production, and trade it for other goods and services which they would like to have, but they're not good at producing. It turns out, when you walk through the math and the very simple algebra, everybody wins. Now, not every person or every industry, but every nation will win in that design. Now, with 1/3 of the world's goods and services being traded, the idea of decoupling, in my view, is a myth. It cannot happen. We are already knitted together. So a significant event in any major trading area, China, Europe, here, will affect the other one. And we're watching that played out in the financial economy. Now, I'd like to highlight, from my point of view, what I think of as the 5 reasons that really got us here. What happened? How did this mess come about? Well, a year ago, I actually talked about some of this that I was reminded of. I just wish it hadn't happened. And the same 5 reasons, I will just repeat that I did at the same forum a year ago. First were the actions of the central bank of the United States. In reaction to the stock market decline of 1999 and 2001, and driven by the fear of repeating the effects in Japan, the Federal Reserve established very easy monetary conditions, and they created the conditions that fostered the boom in the housing market. Now, the housing market boom is very relevant because from peak to trough, if you look at Case-Shiller data, that'll be roughly a 30% decline from peak to trough to get back to average. That's roughly $7 trillion. $7 trillion, if you look at economists' measures of wealth effect, that's going to be in the $600 billion impact to GDP, roughly 1 year's growth. That's what we'll have to live through. I think we can do that, but it's going to take a period of time. So real growth will be quite modest in this country for some period of time. But a second reason was the birth and rapid growth of these new financial products that have these weird acronyms, very poor transparency, and a total absence of regulation. And it really led to the birth of what's called the shadow banking market. The third issue would be the rapid rise of mark-to-model pricing, which you've all read about. Essentially, the rating agencies got in bed with the investment banks, and you kind of had this well, if I do it this way, then you can have that rating, but and really you had these ratings come out that proved to be absolutely valueless. My fellow panelist, by the way, who was not as well received as I was, but I think he was citing how successful he had been, and that was Mr. Paulson, who walked through how he made $3.5 billion last year in his hedge fund.
Not Hank Paulson.
No, not Hank. Not Hank.
Make that distinction.
John Paulson. John Paulson. But it was this hand-to-hand relationship and this sort of corruption between the rating agencies, investment banks, that had these products falsely deemed to be safe. Fourthly, the fourth issue was the rise in the large sums of money in the hedge fund community. The hedge funds had large sources of capital, and they're managed under enormous pressure to speculate with other people's money, and they have built incentives to do that. Fifth was the ability and the incentive to deploy massive use of leverage across a global financial system that wound up with aggregate values in bonds and stocks being multiples of world GDP. So all of this kind of came together right now. As we go forward, and I've been doing this for about 40 years, never have I seen a time of crisis that comes close to what we have before us today. The issue can be solved, but it's going to take a lot of time. But I think it's also helpful if people can kind of catch up to, A, what got us here, what are the steps that have to happen to see a bottom, and I think a lot of it is tied to housing and for the real economy. And then what can happen in terms of policies that are likely to come out of the new administration. And I do believe, and I don't know how many of you had a chance to hear part or all of Warren Buffett's interview on CNBC today, but I thought he was actually quite prescient. He also got a great deal. I wish I could buy the same product. Security that he bought from Goldman, the 10%, with call and warrants, but unfortunately,
we'll talk later.
no one made that offer to us. But not only is he a great investor, I think he's a great American. And I think many of the things he said about the nature of the problem we have, the steps that need to be taken, the support that needs to be provided to Hank Paulson, albeit it needs to be done with, I think, oversight. I think it needs to be bipartisan, and that's something that's been missing in America for a long time. We are too blue or too red. We need a center. Without a center, we got big problems. I'll stop and pass to you.
Paul?
Thank you very much. Well, let me, as an economist by trade, sort of just go back to the basic economic outlook and say a few things about that. Coming into this year, we were looking at the global economy in terms of there being two major shocks hitting the US economy in particular, and to a certain extent some other economies, but certainly indirectly the rest of the world. Those were, of course, the housing recession that was playing out in the US, and the second one was the credit shock, which was leading to a freezing up of the credit market. So they were the two big stories of 2007, the housing recession and the credit shock. And we expected them to play out in 2008 and restrain growth, even into 2009. Another shock came along that we certainly didn't expect, and I think a lot of people didn't expect, which was the commodity price shock. And it was a bit of a puzzle to economists, because if the global economy is slowing, then you would normally expect for there to be less pressure on commodity prices. But that was a third shock, which was a kind of tax on the consumer, and it had another effect which restrains growth, which is it boxed in central banks. Usually when there's a credit shock, when there's a housing recession, central banks try to provide some help by cutting interest rates. The Fed did that, but most other central banks in the world either kept policy on hold or actually hiked interest rates, such as the ECB. Now, what's happened since then? Let's just fast forward to the last 2.5 weeks, and you've already heard this morning from another panel. But it is truly an unprecedented 2.5 weeks, 3 weeks in US and global financial markets history. I think you do have to go back. I don't even know if you went back to the 1930s whether you would see 2 weeks in which so many things happened in financial markets and there were so many critical policy responses, and there was so much rewriting of the financial map. I won't go through the list. It would take 15 minutes just to go through the list of things that happened in the last 2 weeks. I'm not exaggerating there. You've heard about many of them this morning. But it's not just the $700 billion package, which has captured a lot of attention. It's a lot of other things as well. So what does this mean for the outlook for the US economy and for the global economy going forward? Well, it really, in our minds, says that those screws, if you like, on the restraining forces coming through the credit markets have been tightened somewhat. It looks like this freezing up of capital markets is much more serious than really most people had anticipated, and that will restrict the flow of credit to the real economy. It will cause risk appetite to be much drier, if you like, animal spirits to go into hibernation for longer. The good news, though, is that we are getting policy responses here that ultimately should lead to an unfreezing of capital markets and eventually a flow of credit to the economy. But I think we're in somewhat for the long haul here, over the next 1 to 2 years at least, of quite a headwind for growth in the US in particular. After all, we still have housing investment falling, we still have house prices falling, we still have the foreclosure problem, they are mounting. So the forces that are working their way through the real economy from the credit markets have not yet been turned off, but perhaps there's some light at the ultimate end of the tunnel. The second thing I'd just like to say a word about is the sort of, what about the rest of the world, the knock-on effect to the rest of the world, or what's happening in the rest of the world. And I think we have to think in terms of two things. A, there is going to be a knock-on effect to the rest of the world simply because we're moving into a period of slower growth in the US through the trade linkages, through financial linkages. And the world, as has been pointed out by previous speakers, has become a much more interconnected place. For example, if you just look at China, which has been growing at a double-digit rate for the last 5 or 6 years, a lot of that related to China's entry to the WTO at the end of 2001, and the export share of GDP from China has roughly doubled in that 6 or 7 year period, from around about 20% to around about 40%. So if you have a slowdown in the US, a slowdown in import demand, it knocks on directly to the exports from China, and guess what? That starts to knock on to the investment that is also driving the Chinese economy. They have an investment share of GDP of around about 45%. It's colossal. So in looking at the rest of the world, and particularly the emerging markets, where a lot of people sort of put hope, we have to, I think, be realistic here and separate two strands of the argument. Yes, there is a strong secular growth story in the BRICS and the emerging markets, but in the medium-term cyclical outlook, so the next 1 to 2 years, I think it will be virtually impossible for those economies not to slow down fairly substantially. And of course that then feeds back into the US as well. So looking at the global economy, hard to see here anything but a somewhat prolonged slowdown. But bear in mind we do have these aggressive policy responses which is heading off something which could be much worse. Now let me just comment on energy and commodities, because I know that was one of the focuses of this panel, and really make a similar kind of point. Certainly in the team that I've been leading, we were completely blindsided by the run-up in oil prices and commodity prices more generally, because to us it didn't really make sense for oil prices in particular to skyrocket in an environment where you had these big shocks that were hitting the economy and actually getting worse, not better. And Therefore, we certainly didn't expect it to last, and we've been calling for oil prices to fall and other commodity prices to come off, and they are doing that. There's been another sort of shock to the system related to commodity prices, which is of deep concern to economists, and that is the impact on headline inflation. Headline inflation, it's over 5% in the US, it's over 4% in the euro area, it's in double-digit territory in many emerging markets. This is a big problem for central banks, because central banks, by and large these days, are trying to target inflation around about, for the major developed economies, 2%, give or take maybe a percentage or so. So were headline inflation to remain very high, then that would be a trigger potentially for central banks to have to hike interest rates. The Fed, of course, has been doing the opposite. If you have a financial system which is in meltdown mode, if you have a continuing housing shock which is spilling over to the consumer, as Bill pointed out, through the so-called wealth effect, and then on top of that you hit the economy with interest rate hikes, then you're in a very, very nasty situation. The good news that I would present to you is we don't think that's going to happen. We do think oil prices will remain on a downward trend for the time being. We think headline inflation is already coming down, peaked in the third quarter, and will come down, and could come down well below core inflation, which means that central banks around the world in 2009 will, in our view, in my view, be in rate-cutting mode, and would certainly not surprise the team of economists that I've been working with, were the Fed to cut rates in the first half of next year, even by the end of this year, for the ECB and the Bank of England to be cutting rates quite dramatically in 2009. But of course the key there is that headline inflation comes down and gives them that pass. Now you might say, hold on a minute, but aren't energy prices bound to go up because of China and India and everything else? Again, I would just say we need to separate out the longer term secular structural story, as James Glassman, I think in the previous session was pointing out. There is an important price signal that's come out here about the scarcity of energy in the global economy, but in the short to medium term there will be slack in the economy, and price mechanisms will work to dampen down demand, and we think that commodity prices will come off in the medium term, ultimately probably resume some longer term upward trend. So perhaps with those broad comments, I'll leave it there and hand it back to you, Ted.
Well, thank you. You all were just terrific. We have an election coming up, and I would say that neither one of the candidates are particularly known for their economic acumen. So let's just assume for a moment that you each have individually half an hour to spend with the incoming president, whoever that might be. What 2 or 3 things would you tell that person as to what they should do to do 2 things? Address the concerns of the middle class, who are rightfully concerned that globalization hasn't worked from their perspective. They don't see the bigger picture, and that free trade may be working to their disadvantage, and I think there's a concern in this country. Their concerns about not being able to consume as much, becoming generally poorer, and at the same time take the necessary steps to rebalance the economy so that we're living within our means. And I'll let whoever wants to start off with that question, as many people answer it as they want.
Go ahead.
I guess I disagree. I guess you were saying that we're all too red or too blue. And for me, it's quite the opposite. I know this is a very historic election for the United States.
Oh, sorry.
I know it's a very historic election for the United States, but when I look at it, I'd say that Mr. Obama and Mr. McCain have co-sponsored 86 pieces of legislation in the last 4 years. 86 pieces of legislation. You look at the big issues right now facing the United States. Foreign policy-wise, pulling troops out, a time scheduled to pull troops out of Iraq. President Bush has signed on to it. Obama's called for it. McCain agrees with it now. Take those troops out of Iraq, put them in Afghanistan. Both candidates agree with that. Both candidates now agree that the U.S. should be pushing for Georgia and Ukraine to join NATO, pushing for that. They both are supporting, with different twists to it, Secretary of Treasury Paulson's plan. So I kind of think that once again in the United States, and even though it's very colorful characters this time, once again we're presented with this option of Pepsi and Coke, and people need 7-Up. And I think that if I had the privilege to talk to either candidate, I would explain to them that we have to break the psychology of thinking that America is somehow a privileged place. Many of us North Americans use about 150 gallons of water a day. We don't want the whole world to be able to do that. We can't afford for the whole world to do that. We eat so much meat here, which is another substitute for grains and water. When you really look at these things, it's not just a financial system that's unsustainable. Our way of life is unsustainable. And no, politicians don't want to talk about that because it's hard to get elected by selling Americans bad news. I should admit that I'm a Cubs fan. I've been waiting 100 years for this. And so I try to be optimistic about what's going on. But I think that we again, it's in one of these situations, I think we're our own worst enemy. Globalization can work. But here in the United States, we make a big deal about, I mean, I think your point too, free trade helps everybody, a comparative advantage. It helps all countries. The key here is the distribution of wealth. One of the consequences of the maldistribution of wealth is going to be a tax on democracy, a tax on freedom. Not just liberty, the rights of property, but freedom. Believing that we can shape the community in which we live in. So I think that while oftentimes we think about things that we think we're facing a big economic problem, I think most of the time when we think we're facing an economic problem, it's really a political problem. Just like I would suggest to you that the euro, the advent of the euro, was really an economic solution to a political problem. How to convince my friends in France and Poland that it's all right to have Germany be united. Remember, we like Germany so much, thank God there were two of them. Right? And now we have a political, an economic solution, a euro, that binds Europe together in a way that it wasn't bound before. And similarly, I think that what we really have in the U.S. is a political problem, not an economic problem. The economic problem is a reflection of the political problem we have. And I think not only in the U.S., but in the G7. Just to look around the G7 countries right now. In Canada, you have a minority government. They're up for election next month. Likely to also produce a minority government. In the UK, there's a prime minister who could not get elected even if he wanted to. And he'll probably be replaced probably next year. In Japan, they just selected a new prime minister who also has not faced the polls yet. His two predecessors never faced the polls. That leaves, say, Germany with a grand coalition that's unraveling, partly over the Russian invasion of Georgia. So that leaves in the G7, France with Sarkozy. I think his wife is more popular than he is. And then you have Italy, which oddly enough becomes the bastion of political stability in the G7. So with that,
Okay. Well, I guess the question was, what do we do about domestic politics? Yeah, first of all, it wasn't the euro that united Germany. I think that, but basically, I think that the difficulty in the United States now, it goes to Ted's point, which I think is a very good question, and that is Americans at this point, particularly middle and lower income people, do feel that they have not benefited substantially from the increase in productivity that the United States economy as a whole has enjoyed, that there's been a growing income gap in this country, and many of them feel that free trade, individual bilateral trade agreements, NAFTA and other agreements have not advantaged them. And I think that the only way we're going to avoid a more nationalistic reaction to current events, which is what happened during the period of the Depression. A lot of economic nationalism took place, not simply in the United States, but other parts of the world as well, that we talk about our own, other countries had the same thing. We're going to have to deal with the problem of the lack of confidence and the lack of the ability of the middle class to feel that it can thrive in this environment of rapid change domestically and rapid change internationally. And there's some basic things that need to be done. One, the education system in this country is failing the people who need it most. As long as it continues to do that, we are going to have a lot of people who are simply not trained to do the knowledge-driven jobs of the 21st century, and those people are going to fear globalization and fear change in general. Second, you have to have ongoing education and training for people, because people are going to shift careers frequently throughout their lives, and that means corporations who have a great interest in an open global economy and free trade and open capital markets have to do a lot more to invest in the training of their people. Investing in American human capital is going to be the critical investment in whether we succeed or fail internationally, and whether we can maintain an open trade policy. Those are going to be two critical things. The third, I think, and Senator Obama's talked about this, is that it is certainly true that if you look at the returns to upper income people versus middle and lower income people, the tax system for many people in the middle income groups has not been particularly particularly beneficial. And I think he's trying to shift that back and reorient it. And the last point I would make is that one of the things, if we're going to stimulate, and I think we all agree that growth is likely to be slow over the next several quarters, one of the things that has worked, it worked after the Depression, it worked during the Eisenhower years, was something that we need to do anyway, which is a national infrastructure program. We have neglected that dramatically in this country, and instead of giving rebate checks to people, which the government simply has to borrow money for an unproductive use of funds, it can create institutions in banks or entities that can take money, borrow the money, and put it into something productive, which is an improved infrastructure, as long as it's taken out of the realm of pork. Those are the kind of things that I think are well worth doing, and a new president's going to have to do. The problem is that the president's going to confront an enormous budget deficit. It was already going to be $460 to $480 billion before all the recent events of the last couple of weeks. It's going to be a lot higher, but therefore the amount of money the new president has to spend on some of these initiatives is going to be very constrained. That is going to be a huge challenge for the president.
Okay, well, getting back to your question, since I've had a little time to think about it, the issue to me, the first thing I would tell a presidential candidate would be to go out and buy Larry Lindsay's book, which is What Every President Ought to Know But Finds Out Too Late. It's an excellent read, and it even has this little conspiratorial introduction of how he puts this book on the desk of the incoming president, who is unnamed. But it's actually quite a good read. But it's about how you deal with power, and how you start to prioritize whatever you think is important in your decisions. That's the first advice I give to him. Secondly, I tell him to do what's right. Now, it's easy to say, not easy to do. Forget the polls. The polls react to something. In the short run, politics determine economics. But in the long run, economics determine politics. And we need some long-run solutions. We do not need short-term tactical solutions, because they won't work. And it is not going to be easy to attack some of these issues. Whether it's education or economic, you need some long-term solutions. Tell the people the truth. There was a couple of recent editorials, op-ed pieces by Thomas Friedman. I thought they were excellent. I kind of wish he was running. But aside from that, that would be the advice I would give him. I also think this wealth gap is important. If you were to take personal income in this country and group it by deciles, highest to lowest, historically that relationship in this country used to be around 9 to 1. Europe was 7 or 8 to 1 because of a little more socialism. But if you get down to South America, it's 150 to 1. And that top decile needs a private army, gated communities, bulletproof cars. I don't want to live in a world like that. The United States today is 16 to 1. That kind of spread starts to disrupt the center. It starts to destroy shared values. And you are going to have to address that sooner or later. The other thing that would be nice to see from our politicians who are not running is to take a look at these attack ads. If you take a look at some of McCain's ads, which we don't see either one of these in New York because everybody assumes the state's going for Obama, but let's just take a look at the ads. You can see them on YouTube. Some of the ads for McCain are frankly blatant lies. A Republican should stand up and say, this is not the way to conduct an election. Similarly, some of Obama's ads are not particularly at the highest plane they could be. A Democrat should stand up and say, Senator Obama, these ads are not conducive to building a center. We need statesmen, and they are missing in action.
Well, I guess the first thing I'd say is I didn't vote for you, President, because I don't have a vote because I'm Australian. But just to add to the list, I guess a couple of things would be the Fed. I would say to the President, make sure whatever you do in terms of the reappointment process for Chairman Bernanke, which is 2010, that you maintain confidence in a credible, independent a Fed. That's a very important thing for monetary policy. Independence of a central bank doesn't mean that the central bank is off in the clouds not cooperating with the government. We've seen ample evidence in the last few months that that's not the template here. But it is very important that the markets see the Fed as remaining independent in the conduct of monetary policy. I think the financial crisis aftermath is clearly going to still be there, and I think it's very important to sort of have a two-pronged approach, which is really being taken, I guess, at the moment. Deal with the immediate fires, the threats to the financial system, but do so in a way that has an eye on where you're trying to get to longer term. Don't throw the baby out with the bathwater. I think there is going to need to be a very comprehensive post-mortem of what's happened in the last year or two, and I think everything has to be on the table. It's not a simple matter of saying we have to put moral hazard issues to one side now because we have a financial crisis, but then forget about the issues when we come out of it. So some very serious post-mortem and regulatory changes need to take place, but it's very important that those regulatory changes don't cripple the capital market dynamism and infrastructure that exists in this country. And then thirdly, I think a message would be resist the pressures for protectionism and to close down the trading system, because again, as we've heard today, that ultimately at the end of the day is critical to the well-being of people, and it's very short-sighted to have knee-jerk reactions around that. I'd also say, just to come to a point which is, I think we've talked about, the geopolitical the impact on foreign policy of geoeconomic issues here. There is a sort of guns and butter issue. I agree with Bob that I think the US, having lived here for a couple of years, does, and having come from Japan, where there's incredible infrastructure investment, could do with a little bit of a refitting in terms of infrastructure. But can the US maintain its sort of global policeman role in a world in which it is no longer necessarily the global economic superpower? And the one thing that economists know, we had one great law today, the other thing is a thing called a budget constraint. You can't spend money on everything, you have to make choices. And how do you fund and execute the necessary spending for domestic infrastructure if you have this incredible demand on resources to maintain a global security infrastructure? I think that's a big issue that has to be looked at over probably a decade kind of perspective.
I think the quick answer is that it is a dilemma, but there are ways of injecting private sector money into infrastructure which didn't exist to the same degree a decade ago. So if it's done cleverly with private leverage, if I may use that word, a modest amount of private leverage probably would work.
Great. Let me open it up to the audience. I know that Noel is going to be telling me we've got to leave at 11:15. Questions from the audience? Cadet, good.
This question is for Mr. Smets. Sir, you talked a little bit about...
Grab that mic. Okay, grab this one.
Thank you, sir. My question is for Mr. Hormat. Sir, you talked a little bit about the rebalancing in the global economy, specifically money coming back into the United States in terms of investment and spending. Could you talk specifically about if that will happen and what forms that will take from the world economy? Thank you.
Yes, I mean, that's the interesting development over the last decade, and that is that we have absorbed a huge portion of the world's savings, largely because we have such a low savings rate ourselves, and a lot of other countries have very high savings rate. The point was made, for instance, China does, the Middle East does, many parts of the world do. And the question is, one, what have we used it for? A lot of it directly or indirectly went into the housing market to help to get people into the housing market. It kept interest rates low. Even when the Federal Reserve was raising rates, as you recall, medium and long-term rates did not go up. It was called then the Greenspan conundrum, and one of the reasons was that you had a lot of foreign capital coming in. Now, what's changed is that, first of all, our current account deficit is actually, believe it or not, declining because exports, a lot of people thought the U.S. couldn't export. We're exporting a lot. And that is helpful, in part because of demand abroad, in part because of weak demand here. We have an improving trade balance. the foreign capital that's going to come in the future, that's an interesting question. I don't think foreigners are deliberately going to pull the rug out from under the dollar. No one has an interest in doing that. They have a lot of dollar-denominated assets, and they want to sell here. China, in particular, doesn't want the dollar to go down, and their currency, the RMB, the yuan, to go up. So they don't have any interest in doing this. But the fact is, we have got to maintain a very credible financial market in this country. We have to deal with our current financial difficulties, and we have to make sure that over the longer term, even when we've dealt with the current issues, over the medium and longer term, we put our system on a very sound fiscal footing. And if you look at the commitments that we are making in Social Security, Medicare, and Medicaid, with large projected payouts and much smaller projected inflows into those systems through various things like the payroll tax or other kinds of pay-ins, there's going to be a huge gap. Unless we're able to put our economy, our system, particularly our federal financing, on a sound footing, a lot of that foreign capital, which has alternative places to go, there's an alternative currency of the dollar, the euro, a lot of that money will either not come here for economic reasons, or if it comes here, and I suspect a lot of it still will come here, they'll want a higher risk premium if they perceive a long-term imbalance in our finances. And the last point I make is one of the reasons that there was such an interest in dealing with Fannie and Freddie was because a lot of foreigners held those securities, mostly the fixed income securities. And if the United States government had not done something there, I think they were getting messages from all around the world. Look, we regarded those as instruments of the federal government, whether they were formally or informally instruments of the federal government. The rest of the world saw them that way. So we, as a country hugely dependent on foreign capital, have to make sure that we retain the attractiveness of our markets to that foreign capital, and that means keeping faith with foreign investors and dealing with the current set of problems, but over the long term, put our fiscal house in order, and that means addressing Social Security, Medicare, and Medicaid so that we can provide support for people who need it, but not have these things become so fiscally unsustainable that they require more and more borrowing.
Let me add just a couple of things to what Bob said, because I think they're embedded in this. There's an inherent conflict. You sort of have debtors and creditors in the world. Inflation helps debtors and hurts creditors. So if somebody's got the money and you got the debt, it's a problem. And we somehow have to bridge that, because without a stable financial system, it's a huge issue. And if I was a creditor of the United States, the first thing I would make a note, do not buy long-term bonds. Because that note to me would be to say, we will inflate our way out of this to the extent we can, and we will destroy the purchasing power of the dollar you just gave us. But what I would do is I would buy real instruments, and by that I mean companies either directly or in the secondary market or real estate. I'd buy something real. And when you look at equities, a couple of good words about equities. They are the one asset class that ultimately protects you against inflation. As inflation goes from 2% to 4% or 6%, it's very painful for everything except Treasury bills. But at the end, they will have protected you from the 2 to 6 gap. They also capture productivity gains in a global sense. It's the only asset class that does that. And today you have this peculiar situation, it's hard to believe, but so-called earnings yields, you take earnings divided by price, is roughly 8% for the S&P 500, and a 10-year Treasury is less than 4. That's a huge advantage to equities, providing earnings hold up. Even if earnings go down 20%, that gap between the earnings yields and bond yields is actually quite good. So in a sense, if you can make it through this period, which I think is going to be several quarters, maybe to a couple of years, it's very advantageous to equities. And United States stocks are on sale in terms of any other major currency that matters.
Just add something to this. I think that we've seen happening in the last several quarters, actually it's about 2 years now, is foreign direct investment. I think that's your point. Foreigners, besides buying our portfolio assets, which are bonds and stocks, are buying corporate America. And partly, look what's happened to the devaluation of the dollar. The productivity gains that we've been able to register in the United States means that unit labor costs in the United States are very cheap for people in Europe to invest in the United States, for people in Asia to invest in the United States. Some of the most successful textile factories in the world are not in China. They're in the Carolinas. Modern technology, the problem is it's hiring very few workers. So the first thing I'd say is that I would just reiterate that foreign direct investment is coming to the United States, buying our companies. This is one of the net consequences, I think, of the current financial crisis, is the U.S. economy is going to be even more owned by foreign investors, and we have to deal with that. And I think as workers, I've worked for both U.S. companies as well as foreign companies, and I can't tell the difference when I get my paycheck, except I would say that the foreign banks often give more vacation and a better benefit package. But the other thing I would say is that it's not just about the U.S. I mean, often, just on the panel, we're talking about the U.S. having to import this capital because their savings rate is so low. I want to suggest to you that the opposite problems is the way other parts of the world face, the way the other parts of the world encounter it. They have surplus savings. I would suggest to you that since 1980 or so, the U.S. has become a safety valve of the world's excess savings. They give it to us not because, I would argue that it really is not much of an alternative to the U.S. Treasury market. Yes, there's a Euro bond market, but it seems to me that it's like much more like the U.S. muni market. We have a lot of small issuers, different tax schedules, different issuing dates. And so it's not a homogenized market the way the U.S. Treasury market is. But these countries, if they do not get rid of their surplus savings, what happens? Rates of profit fall. It undermines the value of capital. And therefore, it's incumbent upon them, if they can't absorb that capital, to export it. There's not too many other places that have current account deficits that can absorb the excess world savings. And it sounds kind of weird. Here I am, an American, saying we might have a savings deficit. I suspect that we're really mismeasuring it. For example, we don't measure education as an investment. My graduate degrees were an investment that my family made. My son's education is an investment we're making. We don't count that as part of our savings, part of our investment. It's a mismeasuring problem more than I think an actual problem. But I would say that parts of the world do have excess savings, and if they can't export it, they're going to have a bigger problem, and that's going to be a social problem as well as an economic problem.
Can I just, one brief comment just to tie a couple of points here. Bill was pointing out that the US is, and Bob as well, a huge debtor that is borrowing from the rest of the world. We're now seeing program after program, a couple of $100 billion earmarked for the GSEs, $700 billion for the illiquid assets, where it looks like the federal government is opening up a huge checkbook to pay for the financial crisis cleanup. And a lot of people are going to start to think, is the US going to reflate its way out, print money, and get out of this that way? That's the whole point of having an independent central bank that has effectively a kind of inflation target of 2%. And that was why I said my first advice to the incoming administration would be keep the Fed independent, because if people in the global economy see that slipping, then you go down a slippery slope very, very quickly, and you can't reflate your way out of problems because the rest of the world will get onto it and pull their money out.
Good. I think we have time for perhaps one more question. No, I've just been overruled. Okay. All right. Well, let's thank our panel.